Welcome to our deep dive into digital currency regulations. In recent years, digital currencies like Bitcoin and Ethereum have transformed the way we think about money, investment, and even privacy. But with this innovation comes the need for clear rules and oversight. Today, we'll explore how governments and organizations around the world are responding to the rise of digital currencies, what regulations are being put in place, and why these rules matter for everyone involved. Let's start by understanding what digital currencies are and why they've become so popular. Digital currency refers to any form of money or asset that exists solely in electronic form. Unlike traditional cash or coins, digital currencies are stored and transacted online, often using blockchain technology. This makes them fast, borderless, and accessible to anyone with an internet connection. However, their digital nature also raises questions about security, privacy, and regulation. Understanding these basics is crucial before we dive into the regulatory landscape. As digital currencies gained popularity, concerns about their use in illegal activities, tax evasion, and financial instability grew. Governments realized that without proper regulations, these currencies could be misused or cause harm to the broader economy. Regulation aims to protect consumers, prevent crime, and ensure the stability of financial systems. It's a balancing act between encouraging innovation and maintaining order. Different countries have taken various approaches to regulating digital currencies. Some, like Japan, have embraced cryptocurrencies and created clear legal frameworks. Others, such as China, have imposed strict bans on trading and mining. Meanwhile, the United States and European Union are working on comprehensive regulations that balance innovation with risk management. These diverse strategies reflect each country's priorities and concerns. Several organizations play a crucial role in shaping digital currency regulations. In the United States, the Securities and Exchange Commission (SEC) and the Commodity Futures Trading Commission (CFTC) oversee aspects of cryptocurrency markets. Internationally, the Financial Action Task Force (FATF) sets anti-money laundering standards. These bodies work to ensure that digital currencies are used safely and legally. Many countries now require digital currency exchanges and wallet providers to obtain licenses or register with authorities. This process helps regulators monitor activities, enforce compliance, and protect users from fraud. Licensing also brings legitimacy to the industry, encouraging more people to participate in the digital economy. Anti-money laundering regulations are a cornerstone of digital currency oversight. Exchanges and service providers must verify the identities of their users and report suspicious activities. These measures help prevent digital currencies from being used to launder money or finance terrorism, making the ecosystem safer for everyone. Know Your Customer, or KYC, is a process where digital currency platforms collect information about their users. This includes verifying names, addresses, and sometimes even sources of funds. KYC helps authorities track transactions and prevent illegal activities, but it also raises concerns about privacy and data security. Tax authorities worldwide are paying close attention to digital currencies. In many countries, profits from buying, selling, or trading cryptocurrencies are subject to capital gains tax. Some governments require exchanges to report user transactions, making it easier to track taxable events. Understanding your tax obligations is essential for anyone involved in digital currencies. Regulators are increasingly focused on protecting consumers in the digital currency space. This includes requiring clear disclosures, ensuring fair trading practices, and providing avenues for dispute resolution. These protections help build trust and encourage more people to use digital currencies safely. Stablecoins are digital currencies pegged to stable assets like the US dollar. Because they aim to reduce volatility, regulators are paying special attention to how these coins are managed and backed. Ensuring transparency and proper reserves is key to maintaining trust in stablecoins and preventing financial risks. Initial coin offerings, or ICOs, are a way for companies to raise funds by issuing new digital tokens. Regulators often treat ICOs as securities, subjecting them to strict rules and disclosures. This helps protect investors from scams and ensures that only legitimate projects can raise money through ICOs. Security tokens represent ownership in real-world assets like stocks or real estate, but in digital form. Because they are considered securities, they must comply with existing financial regulations. This ensures investor protection and market integrity, but also adds complexity to issuing and trading these tokens. Centralized finance, or DeFi, refers to financial services built on blockchain technology that operate without traditional intermediaries. While DeFi offers innovation and accessibility, it also presents regulatory challenges. Without a central authority, enforcing rules and protecting users becomes more difficult, prompting regulators to seek new approaches. Central bank digital currencies, or CBDCs, are digital versions of national currencies issued by central banks. Unlike cryptocurrencies, CBDCs are fully regulated and backed by governments. Many countries are exploring or piloting CBDCs to modernize payment systems and enhance financial inclusion, while maintaining control over monetary policy. Privacy coins like Monero and Zcash are designed to make transactions untraceable. While they offer enhanced privacy for users, they also pose challenges for regulators trying to prevent illegal activities. Some countries have banned or restricted privacy coins, while others are developing new tools to monitor their use. Digital currencies make it easy to send money across borders, but this also complicates regulation. Different countries have different rules, and coordinating enforcement can be difficult. International cooperation is essential to prevent regulatory gaps and ensure that digital currencies are used responsibly worldwide. Crypto mining is the process of validating transactions and creating new coins. Some countries have welcomed mining as an economic opportunity, while others have banned it due to concerns about energy consumption and environmental impact. Regulations often focus on licensing, taxation, and environmental standards. Digital wallets are used to store cryptocurrencies, making their security a top priority. Regulators may require wallet providers to implement strong security measures such as encryption and multi-factor authentication. These standards help protect users from hacks and theft, building confidence in the digital currency ecosystem. To prevent scams and misleading information, many countries have introduced rules for advertising digital currencies. These regulations require clear disclosures about risks and prohibit false or exaggerated claims. By ensuring honest marketing, regulators aim to protect consumers and maintain market integrity. Crypto derivatives, such as futures and options, allow investors to speculate on price movements. These products are often subject to strict regulations to prevent excessive risk and market manipulation. Exchanges offering derivatives must comply with licensing, reporting, and transparency requirements. Custody refers to the safekeeping of digital assets on behalf of clients. Regulators require custodians to follow strict security protocols and maintain insurance against loss or theft. These rules help ensure that users' assets are protected even if a service provider faces problems. To detect and prevent fraud, regulators use market surveillance tools to monitor trading activity. These systems can identify suspicious patterns, insider trading, and market manipulation. By keeping a close watch, authorities help maintain fair and orderly digital currency markets. Handling sensitive user data is a major concern in digital currency regulation. Laws like the EU's GDPR require platforms to protect personal information and give users control over their data. Balancing privacy with regulatory needs is an ongoing challenge for both companies and authorities. Some countries have created regulatory sandboxes, allowing digital currency startups to test new products under supervision. This encourages innovation while ensuring that risks are managed. Sandboxes provide a safe space for experimentation and help regulators understand emerging technologies. Because digital currencies operate globally, international cooperation is essential for effective regulation. Organizations like the G20 and FATF work to harmonize rules and share best practices. By working together, countries can close regulatory gaps and combat cross-border crime. The digital currency landscape is constantly evolving, bringing new risks such as cyberattacks, fraud, and technological failures. Regulators must stay vigilant and adapt their approaches to address these threats. Ongoing research and collaboration are key to keeping the ecosystem safe. Educating the public about digital currencies and their risks is a priority for many regulators. Campaigns focus on helping people recognize scams, understand their rights, and make informed decisions. Well-informed users are less likely to fall victim to fraud and more likely to use digital currencies responsibly. Regulation can both support and hinder innovation in the digital currency space. Clear rules provide certainty for businesses and investors, but overly strict regulations may stifle creativity. Finding the right balance is crucial for fostering a healthy, innovative ecosystem. In addition to government oversight, the digital currency industry often adopts self-regulatory measures. Industry groups set standards for security, transparency, and ethical conduct. Self-regulation can complement official rules and help build trust among users and regulators alike. When companies or individuals break digital currency regulations, authorities may take enforcement actions. This can include fines, bans, or even criminal charges. High-profile cases serve as warnings and help deter future violations, reinforcing the importance of compliance. As technology evolves, so will digital currency regulations. Policymakers are exploring new frameworks to address emerging trends like NFTs, decentralized autonomous organizations (DAOs), and cross-chain interoperability. Staying flexible and responsive will be essential for effective regulation in the years ahead. Non-fungible tokens, or NFTs, have exploded in popularity, raising new legal questions. Regulators are examining how NFTs fit into existing laws, especially regarding intellectual property and consumer protection. Clear guidelines will help creators, buyers, and platforms navigate this rapidly growing market. Decentralized autonomous organizations, or DAOs, are groups that operate using smart contracts and collective decision-making. Regulators are still figuring out how to oversee DAOs, as they don't fit neatly into traditional legal structures. Ongoing dialogue between innovators and authorities is crucial for developing effective governance models. Cross-chain interoperability allows different blockchains to communicate and share information. While this boosts innovation and efficiency, it also creates new regulatory challenges. Ensuring security and compliance across multiple networks will require updated rules and close collaboration between stakeholders. The environmental impact of digital currencies, especially those using proof-of-work mining, has attracted regulatory attention. Some countries are introducing rules to limit energy consumption or encourage greener alternatives. Balancing innovation with environmental responsibility is becoming a key focus. Crypto lending platforms allow users to borrow and lend digital assets, often with attractive interest rates. Regulators are developing rules to ensure these platforms operate safely, protect lenders and borrowers, and prevent systemic risks. Transparency and proper risk management are essential. Insurance products are emerging to protect digital currency users against theft, hacks, and loss. Regulators are setting standards for these products to ensure they are reliable and transparent. Insurance helps build confidence in digital currencies by reducing the risks associated with their use. Technology providers, such as wallet developers and blockchain infrastructure companies, play a vital role in the digital currency ecosystem. Regulators may require these providers to meet security and compliance standards, ensuring that the underlying technology is safe and trustworthy for users. To encourage reporting of illegal or unethical behavior, some regulators offer protections and rewards for whistleblowers in the digital currency industry. These measures help uncover fraud and misconduct, making the market safer for everyone involved. Disputes can arise between users, exchanges, or service providers in the digital currency space. Regulators may require platforms to offer clear dispute resolution processes such as arbitration or mediation. These mechanisms help resolve conflicts fairly and efficiently, supporting user trust. Regulators are also considering how digital currency rules can promote financial inclusion. By ensuring that regulations do not create unnecessary barriers, more people can access digital financial services. This can help bridge gaps in traditional banking and empower underserved communities. Digital currency regulations are not static. Authorities regularly review and update rules to keep pace with technological advances and market changes. This ongoing process ensures that regulations remain effective and relevant, protecting users and supporting innovation. Collaboration between regulators, industry participants, and technology experts is essential for effective digital currency regulation. By working together, stakeholders can identify challenges, share solutions, and create rules that support both innovation and safety. Digital currency regulations are evolving rapidly, reflecting the dynamic nature of technology and finance. As we've seen, effective regulation requires a careful balance between innovation, security, and consumer protection. By staying informed and engaged, all stakeholders can help shape a digital currency ecosystem that is safe, inclusive, and full of opportunity for the future.